about making a market. Here we are, SMF, MMTs. Look at here, $630 call. Look at Google. Look at Google. This is an options expiration. Let me explain you. Here's a 670 call yesterday, MMTs, that we took our $12,000 profit on and sold it on our 30 contracts. And they're coming right back down close to our original entries. And we do have a pricing control model that would allow the MMT to get a wholesale bid for a trade. And that's the 3/19/2011 670 call right there. Look at here, the high was $12. They're stealing almost $4. Well, $4 premium came down, 4.10. We already know what they're going to do. This is a $630 call, MMTs, that you've seen earlier in the day. And basically, the high on the Google stock, which is right here, it was 641.73 ratio. Now that we have entered into the final Friday in the curtain of the contract, that means that either it will expire for the value that it is, and or people can exercise their option contracts into stock ownership depending on various strike prices and different things that they're doing with the options expiration. We could care less. We're market makers. We buy wholesale. All right, $12. I'm expiring, and we got some people hit in these contracts that people that need to understand that we got down here to that low. And basically, let's click on, let's get down here below the floor. All right, so here we're going to go down here at $1.25 on 10 contracts, and we're going to hit buy. And this is what we're going to do. Whoops. And we're going to hit OK. And Smart X, hit yes. There is what we're buying. Buy to open 10 of these 630 calls that expire today at $1.25, and hit OK. And now the order's out there and we're ready to go. And that's the bottom line. The other part of the Google trade is to understand that when they take out that amount of pricing premium, that obviously I see a problem with the pricing controls. However, the MMT market maker is down below the floor because that's a nice wholesale bid. $12 is the high. The previous day's close was $6.13. I'm $1.50 below the market right now. But I'm down here because I know that this is a wholesale bid area that I'd like to be at. And I also know that I would be the king market maker on the street at $1.25 with a big bounce between now and the closing bell. Right now it's only 7:58 a.m. Pacific Standard Time. Today's date, 1/21/2011, January. Options expiration. Pricing control market maker in action at the wholesale bid. As we keep falling in value over here, we can see the premium come down. And Google is only 0.7582 cents, and this is all price action volatility in all of these contracts. As we watch the March one right over here, we're very well in tuned that we can take advantage of getting the right price on Google. And I lost one of my market minders, but we'll go get it. Here we are. We're coming down to that $1.25. And I'm going to pull up a chart now to make sure that we're getting pricing control mechanism at that wholesale bid, as we're watching this very live right now. And we're going to see here, I'm going to ask Scotty Schubeck to tell me where the IR is. If it's weak at zero, Well, thank you. I can cancel the order because it's at zero. Oh, boy. Let's go down to the next market. He told me it was at zero. Well, that means that we can undercut the market. Let's go 85 cents. We made the adjustment. There's the adjustment. Buy right there. $8.50 is the cost. We took it down from the $1.25 because he told me, oh, it's at zero. Well, yeah, if it is at zero in the brain, then I need to get out of the way. How about that? How about that? So we hit $1.40. They were $12 on the high. And not only that, what I want people to really understand is during this options we're out at 85 cents. It's $1.55 by 60 here and now. 8 o'clock a.m. So the market's been open an hour and a half. There's a long day left for this. And you're going to get manipulation between that bid and that ask. So MMTs, when you're making an execution, you would learn how to just click on the thing, the price would show up, and you'd hit buy, and you'd be below the market just like I did at 85 cents. See, if I click on 70 pennies, I can adjust that very quickly. Bam. I know exactly what I'm doing. I get my orders out there. This is the execution system. It's not hard to do. It doesn't bite you either. I promise. Because you're given a limit price. And in this case, we're starting to bounce in the name, and that's why the call price is bouncing. So as we go throughout the day, we're going to examine if that is the final curtain, or is that just a teeny bounce in the option pricing control. MMTs here I have on the tape, and let me get this all in here so that you can see here that when your equity market maker platform goes up this way, your option bounces from $1.40 and goes up in value. That means expanding ratio value based on the move up here at 626, which is yesterday's, where it gapped and they sold it straight down. MMTs, look, this is what they did. And why they were doing this, that's when they were taking the most premium out of the contracts. Now what you'll see, when they lever up in the trend, then you're going to come back, and this is how you lever up in price, meaning up in value, and you sell back to the public because you got the spread of the entry of the 630 call at the bottom, and your equity platform and your brain on monitor 1, your options brain over on monitor 1 is the one that does the prices here. And when this moves, the premiums moving there, this price is what they're doing in this brain over here. It's not on the video, so you're not going to see it, but the people in the live room here can see it. So what I'm saying is that this particular wholesale pricing, wholesale is for you to be here and then sell them back to the public. And your 3-minute equity brain, your market maker platform here, when you move up and you keep going higher, you'll get more spread and value going higher in the option. All you need to know is getting the wholesale bid and directional ratio movement. So when I have an upside ratio, then I have an upside ratio here. When the ratio doesn't go any higher, then I would know how to sell the contract, and I would have took my profits while everyone else is holding it on a pullback possibly. I got out of the top of the move off $1.40 there, and now it can come down in value. Let us not forget that we have a live order at 85 cents as well. So we already have a bid out there on a different exchange, and we know how to put lots of bids out on different exchanges. And so we can line the bids, and the thing about it is it's all about lining that bid. And it's all about, during the options expiration MMTs, is we had great news. It's an expiration. Google had great earnings. It doesn't matter. This is wholesale down here, and the retail public Hey, they were $13. They wrote them all the way down on the final day. That's today. That means that I've explained to you, I'm not going to say it in the videos, but in the live room, you know what that means. The market maker was getting paid from $13.10 down to $1.40, and still is getting paid. And that's the reversal of that movement. So when you were looking at in the money put options, they could steal money out of both sides of the market on the pricing. So you always have to be wholesale and selling back to the public. And your 3-minute charts will also help you, and all of your brain functions will be working correctly. So when your ratios do their thing here, MMTs, when your ratios work in one direction here, then they work with option price movement up, and they also work with option prices moving down for the call side, and the put side is when the equity falls in value, you get a premium spread there. And will be throughout the day, it's 7 minutes later, we will be happy to show right down to the last minute of this options expiration. We don't give this in a free 5-day trial. I want everyone to know that. If you want to pay your $3,500 to attend a 5-day event every month, there's 12 in a calendar year, you would have to make a phone call and schedule that, and also prepay for it. And we still have our bids out here at 85 pennies. See, our bids are 85 pennies here. And we also have that FCX call contract at 15 pennies on the day. And we got down to 43 pennies, but we still have bids there. 15 pennies on the 110 call on FCX. And we have the Google at 85 pennies over here. So once again, what we're going to do is we're at $1.70, and we're holding the price area in the brain, in the equity brain, on that side of the market, because we are. So when you take a look at where that 1.65 and 1.85 is, that an MMT, if we're in a reversal, you're going to get back below that market, because what's going to happen is, if we start to break down here on the 3-minute chart, then these price bids are going to fall in value. They're going to go descending in value. And that's where the wholesale market maker, MMT market maker entry is, selling back to the public. Just like up $1.40 to $2.20. And you make the money and you sell them back. And this is the good thing about this kind of market with a high volatile stock that creates a market in this particular 6:30 call today. It's below the strike price. So once again, MMTs, watching this side of the brain, because when this goes ratio ascending or ratio descending, that's also going to be the outcome of the call contract descending or ascending in value as well. This has been a special gift to the new MMTs. First options expiration, January 2011. And it's good for you to see how the public can just really put themselves in a frenzy. Down $11.30. Google had the greatest news in the world. There is no fairness in options expiration. And you are being trained to be a wholesale person that buys and sells to the public model. MMTs, you've been given a gift.